This is About Claude, a daily digest of news and discourse about the AI I keep coming back to. Whether you're a budding power user or merely Claude curious, we aim to keep you informed and help you make sense of where Claude is headed. 3 weeks ago on this show, we covered the day Anthropic launched a legal plugin for Claude and watched billions evaporate from public legal software companies in a single afternoon. Thomson Reuters dropped 16%. The London Stock Exchange Group fell 13%. In that episode, we said something I want to come back to. The next time Anthropic releases a plugin for healthcare or finance or accounting or engineering, watch the stock tickers of incumbent software companies in those sectors. The pattern is now established. Last Friday, Anthropic launched Claude Code Security. AI-powered vulnerability scanning built directly into Claude Code. The system reads and reasons about code the way a human security researcher would, except it doesn't get tired and it doesn't miss things. Using Opus 4.6, it found over 500 previously unknown vulnerabilities in widely used open source projects. 500. Bugs that human security teams have been walking past for years. CrowdStrike dropped 8%. Cloudflare fell 8.1%. SailPoint lost 9.4%. Barclays called the sell-off illogical. 3 weeks. Different sector. Same pattern. But we're going to pull out further today because it's not just one sector or two. It's the whole landscape. Earlier this month, JPMorgan published a note that stopped people in their tracks. Software companies, they wrote, have lost around $2 trillion in market capitalization over the past year. The largest non-recessionary 12-month drawdown in over 30 years. $2 trillion, not in speculative crypto tokens or meme stocks. In Salesforce, Adobe, ServiceNow, Palantir. Companies that were the backbone of the last decade's technology thesis. What's happening? Why now? And is the market panicking about the right thing? Let's start with the panic, because the panic has a name. Traders at Jefferies have christened it the SaaSpocalypse, an apocalypse for software as a service stocks. And their description of the trading floor is vivid. Very much get-me-out style selling, not repositioning, not hedging, liquidation. The narrative driving the exits is straightforward. AI agents will kill SaaS, Claude Cowork, Vibe coding, the end of enterprise software as we know it. Goldman Sachs issued a note this week comparing the software sector to newspapers, a warning about long-term downside risk that invoked one of the most devastating industry collapses in recent memory. Newspapers, Goldman's Ben Snyder reminded clients, faced technological disruption from the internet in the early 2000s. The multi-year decline in newspaper stocks only ended when earnings estimates finally bottomed. And in many cases, by the time that happened, most of the equity value was already gone. That comparison landed like a grenade. Piper Sandler downgraded Adobe, Freshworks and Vertex, with their analyst Billy Fitzsimmons citing concerns that seat compression and vibe coding narratives could set a ceiling on multiples. Palantir, last year's market darling, is down 22% year-to-date. Adobe, Salesforce and ServiceNow have all shed 25 to 30%. Forward earnings multiples for the software industry, which averaged 39 times just a year ago, have collapsed to 21. Price-to-sales ratios have compressed from 9 times to 6, levels not seen since the mid-2000s. And the mechanism behind all of this has a clean name: seat compression. Jason Lemkin at SaaSta gave the formulation that everyone is now using. If 10 AI agents can do the work of 100 sales reps, you don't need 100 Salesforce seats anymore. You need 10. That's a 90% reduction in seat revenue for the same work output. The software still exists. It still runs, but the number of humans paying for it shrinks dramatically. Meanwhile, enterprise CIOs are consolidating. A January survey showed IT budget growth expected to decelerate to just 3.4%. But the internal shift is far more dramatic. Funds are being diverted from application software toward the massive compute costs of AI infrastructure. Every enterprise wants fewer vendors, not more. The best-of-breed era of buying specialized point solutions is over. Companies want platforms, not products. They want to reduce complexity, not add it. That's the panic narrative, and it has real numbers behind it. But here's what the panic narrative often lacks: a human being, in a specific place, doing a specific thing. So let's go to Sweden. On February 10th, Spotify held its fourth quarter earnings call. The financials were strong: 751 million monthly active users, revenue up, record operating income. Good results. But nobody was talking about the numbers the next morning. They were talking about a single sentence from co-CEO Gustav Söderström. When I speak to my most senior engineers, the best developers we had, they actually say that they have not written a single line of code since December. Let that land for a moment. Spotify's best developers, not writing code, since December. What they're doing instead is orchestrating. Spotify has built an internal system called Honk. And yes, that's really what it's called. Layered on top of Claude Code. Here's how Söderström described it to analysts. An engineer at Spotify on their morning commute from Slack on their cell phone can tell Claude to fix a bug or add a new feature to the iOS app. And once Claude finishes that work, the engineer then gets a new version of the app, pushed to them on Slack on their phone, so that he can then merge it to production, all before they even arrive at the office. From the bus, on a phone, through Slack, a new version of one of the most used apps on the planet, shipped before the engineer gets to the office. Söderström credited Honk and Claude Code with speeding us up tremendously and called it just the beginning. Spotify shipped more than 50 new features and changes throughout 2025. The company traces the acceleration to the December release of Opus 4.5 within Claude Code, what Söderström called a singular event that crossed a productivity threshold. The quote travelled fast. Within 48 hours, it had 14,000 upvotes on Reddit's r/technology subreddit, with over 2,300 comments that were overwhelmingly skeptical. Developers called it everything from corporate delusion to the beginning of the end. One commenter wrote, "Please don't work during your morning commute, especially if you're the one driving." Another, "It's Spotify, it doesn't have to work correctly." A third, more pointedly, "I'll worry when one of my financial institutions does this." The skepticism is interesting because it tells you something about where the gap is. The corporate narrative says the transformation is already here. The practitioner community says, "Show me the receipts." And there's a study that sits uncomfortably between the two. METR, an independent research group, found that perceived AI productivity gains can diverge significantly from measured ones when tested rigorously. The Spotify engineers feel faster. Whether they actually are at scale, over time, with fewer bugs, that's a different question. But here's what isn't a question: whether this changes how many people Spotify needs doing a particular kind of work. If your best developers are shipping features from the bus, you need fewer developers at the desk. That's seat compression. Not in a Goldman Sachs note. On a bus in Stockholm. Now. The counter-narrative, because there is one, and it's not nothing. Not everyone is running for the exits. Some of the most respected voices on Wall Street think the sell-off has dramatically overshot. Dan Ives at Wedbush Securities calls it a generational buying opportunity and argues the market is baking in a doomsday scenario that is likely exaggerated. Large enterprises, Ives points out, took decades to accumulate trillions of data points now ingrained in their software infrastructure. You don't rip that out because a new AI tool had a good demo. JPMorgan strategists took a similarly bullish position, calling the AI disruption narrative an overly bearish outlook, and arguing investors should expect a rebound, given otherwise solid fundamentals. Software companies, they noted, still benefit from high switching costs and multi-year contracts that insulate them from rapid disruption. Goldman Sachs CEO David Solomon called the sell-off too broad. Not every software company faces the same exposure. And then there's Jensen Huang, who has been unequivocal. The idea that AI will suddenly kill the software industry is illogical. AI will largely use existing software platforms as tools to improve them, not replace them outright. Jason Lemkin, who gave us the seat compression formulation, is interesting here because he's on both sides of the argument, and he knows it. His SaaStra analysis is worth dwelling on. Nobody is building a homegrown CRM in Replit to replace their Salesforce instance, he writes. I've built 10 plus apps with vibe coding in the past few months, things that would have taken a team 6 months. I did in hours. but none of them replace enterprise systems of record. And then the line that I think cuts deepest. Shipping a V1 is maybe 2% of the work. His broader argument is that the crash is real, but the narrative explaining it is wrong. The growth deceleration in enterprise software started in 2021. Revenue growth at many major SaaS companies has been slowing for 3 years. What the market is doing, Lemkin argues, is finally pricing in the numbers they actually have, not the growth rates they were hoping for. AI disruption didn't cause the repricing. It gave the market permission to do what the fundamentals had been demanding for years. ServiceNow dropped 11%, despite beating earnings for the 9th consecutive quarter. Think about that. 9 straight beats, and the stock still cratered. That's not AI disruption. That's a market deciding the growth premium was never justified in the first place. So both narratives have merit. The panic camp is right that the per-seat revenue model is structurally under pressure. The skeptics are right that nobody's replacing enterprise infrastructure overnight. They're arguing about different timeframes, and they're both partially correct. But here's where I want to come back to something, because I think both sides are missing the thing that's actually changed. In early February, Anthropic launched its legal plugin. One announcement, one afternoon. Billions wiped from legal software stocks. We covered it on this show and said, the pattern is established. Watch the tickers. 3 weeks later, last Friday, Claude Code Security. One announcement, one afternoon. CrowdStrike, Cloudflare, SailPoint, Okta, all down significantly. Barclays called it illogical. It sounded exactly like what people said about the legal sell-off 3 weeks earlier. And in between those two events, the entire SaaS sector, $2 trillion. The interval between shocks is compressing, and the mechanism is evolving. The legal plugin was Anthropic pointing Claude at a profession. That's disruption by configuration. Take existing capability, aim it at a domain, watch the incumbents flinch. Claude Code Security is something different. Claude didn't just scan code the way existing tools do. It found 500 previously unknown vulnerabilities. It wasn't replacing security analysts. It was doing something they hadn't done yet. That's a different kind of disruption than seat compression. Seat compression says, we need fewer humans to do the same work. The security story says, the AI is doing work that wasn't being done at all. The counter-narrative is right that nobody's replacing Salesforce tomorrow, but the structural shift isn't a single replacement event. It's a rolling series of them. Legal, then security, then coding workflows, then whatever comes next. Each arriving faster, each landing wider. And each time the initial market reaction is dismissed as illogical. And each time the pattern holds. Lemkin's deeper point, that this is really a repricing of growth expectations that were already unrealistic, is persuasive. But it coexists with something else. It coexists with an engineer on a bus in Stockholm shipping production code through Slack. It coexists with a vulnerability scanner that found things human teams had missed for years. It coexists with the fact that 3 weeks is now the gap between one sector being disrupted and the next. At some point, the pattern is the logic. Both sides of the SaaSpocalypse debate are partially right. The skeptics are correct about timeframes. Enterprise software doesn't get replaced in a quarter. The bears are correct about direction. The per-seat model is under genuine structural pressure. But what neither side seems to have fully absorbed is the pace. 3 weeks between the first shock and the second. The question isn't whether AI changes the software industry. That debate is settled. The question is whether the market can reprice fast enough to keep up with what's arriving. That's all from us, Neil and Claude. Thanks for listening. We'll catch you tomorrow.